Welcome to Lesson 1. Today in Lesson 1, we're going to talk about your tax story, the 3 stages or chapters in your tax story. These 3 chapters are summarized as your working years, which all of you are very familiar with because most likely you're in your working years or most of your life has been in your working years. The second chapter is your Social Security start years, or the years that you start taking your Social Security. And then your final chapter is your required minimum distribution years, or the years which you're 70 and a half and forced to take a distribution from your tax deferred accounts. So these are the 3 stages or chapters of your tax story that we're going to talk about in Lesson 1. To explain a tax story, I actually want to share a story with you that will actually relate to and revert back to throughout this course to give you a good idea of what a tax story is. So follow along as I tell you a story about Bill and Janet. Bill and Janet recently celebrated their 30th anniversary and recalled the many fun and challenging experiences that they had while building a life together. As they looked back with appreciation for the last 30 years together, they wondered what the next 30 years had in store for them, especially because they were only 10 years before retirement, and they wondered if they could continue their same enjoyable lifestyle without the fear of running out of money. Now, at the young age of 55, they have a modest home in the suburbs of the city, 3 children that recently started their families, 2 grandchildren, and a family dog named Chance. Bill is a project manager, a conservative investor, and a playful grandfather. He is also concerned about the financial health of our country and how it might increase tax rates in the future and affect their retirement income. Janet is a school teacher. She loves to write stories, and her children and grandchildren are her greatest joys. Both Bill and Janet make it a priority to be actively involved in their local church and charity organizations, and they donate both time and money to enrich the lives of those in need. Now, Bill, being a problem solver, and Janet, being a story writer, wanted to know what their retirement finances, particularly their taxes, look like now compared to when they retire at the age of 65 and also at the age of 70, a few years into retirement. So they sat down to write what their life might look like at each of these time periods. They called it their tax story. In chapter 1, called The Working Years, was about where they were today at the age of 55. Life was full of busy work schedules, deadlines, and free time that was limited to only Saturdays. Their income consisted of a modest salaries from both Bill's employer and Janet's school, as well as their old home that they kept rented out consistently. They had a few tax-deductible expenses that consisted of interest on their home mortgage, naturally, their tithing contributions, their property taxes, and state income tax. There were no surprises in this chapter of their finances because they had been about the same for many years. However, chapter 2, called the Social Security start years, was about how their retirement finances changed once they both retire at the age of 65. Now that they were retired, they wanted to visit a few much anticipated destinations and take a break from the daily work routine. Now, every day was a Saturday. Their salaries were replaced by modest pensions, and they both applied for their Social Security benefits to start the month after retirement. The chapter started off smoothly, but quickly got suspenseful when they realized that half of their Social Security benefit was going to be taxed. Bill was not happy to hear that he had paid tax on Social Security contributions for the past 45 years, and now he had to pay tax again. Janet was also surprised to learn that even though they were now retired and earning less than in their working years, they were still in the same marginal tax bracket. Now, chapter 3, called the required minimum distribution years, was about how their retirement finances changed once again when they were required to take a taxable distribution from both of their 401k accounts. Bill and Janet were now spending almost all of their free time enjoying their grandchildren's personalities, recitals, and sporting events. They also took advantage of service opportunities weekly, as well as a few extended period service missions away from their home. They were aware that once they turned 70 and a half, that they would be required to take a withdrawal from their 401k accounts, but the tragedy of their withdrawal was not seen until the end when they received their tax bill. Yikes. The effect of their RMD was that now 85% of their Social Security benefits were taxed. Their marginal tax rate was increased to 22%, and they were now paying more taxes than they were while in their working years. How did they not know that diligently saving in a 401k and years of working toward earning a pension would ultimately set them up in this tax situation. They concluded that it was what they didn't know that most hurt their retirement finances. Bill and Janet's tax story helped them understand where they were today and foresee some of the unintended consequences of the types of retirement savings and retirement income that they had worked so hard to create. Let's add a few of the background details to their tax story and then review the highlights. In Chapter 1, Bill and Janet's income was $110,000, and their itemized deductions were $35,000, which created a taxable income of $75,000 and put them in the top of the 12% tax bracket. In Chapter 2, their income was reduced to $70,000, and now they took the standard deduction of $26,600, which created a taxable income of $28,750. And kept them, surprisingly, in the 12% bracket. Now, let me pause for a minute. Conventional financial wisdom would say that you will be in a lower bracket in retirement. But for Bill and Janet, they stayed in the same tax bracket even though their income went down. Now let's continue on into Chapter 3. In Chapter 3, their RMD, or required minimum distribution, of $40,000 boosted their income back up to $110,000, and they continued to take the standard deduction of $26,600, which created a taxable income of $78,900. Now, this additional income from their 401k pushed them up into the 22% bracket, almost doubling it from 12%. Their RMD income will most likely keep them there throughout their retirement. Also, they will now pay taxes on 85% of their Social Security benefit instead of the 50% initially. A couple of things to point out or highlights in this is, again, between their ages of 55 and 65, or their working years and Social Security start years. If you notice the yellow bar, that's their marginal rate. It stayed the same, and it only was increased after they turned 70 and their required minimum distributions bumped it up to 22%. A couple other items to notice is at 65, if you notice, their income went down, and so did their deductions. This often happens when we pay off our mortgage and have less deductions into retirement. Now at the age of 70, if you'll notice that again, their taxable income went way up because of their 401k distribution. Now that we've learned about the 3 stages of a tax story, that concludes lesson 1. We look forward to section 3 later on in this course that we'll have the chance to put together your tax story. And so you'll be able to understand at each of those 3 chapters or stages of your tax story what your income will be, deductions, and marginal rates. So we're looking forward to doing that in chapter 3, but that concludes lesson 1. We'll see you in lesson 2.